Hey guys, welcome to another video. Thanks for joining me in this one. So in this video, I'll be sharing with you the two certificate of deposit accounts that you can open with two banks, or two separate banks, and they are paying as high as 3% interest rate or APR. Now, the truth about it is that due to the most recent, fluctuations in the industry, with interest rates being low, inflation being high, all those factors have driven, certificate of deposit and savings accounts to pay very little amount of, interest on any money you put into those accounts. But as interest rates has been increased by the Fed, so as your savings rate or interest rate on the savings account and also the certificate of deposit interest are being increased as well. If you're new here, my name is Stephen Ojo, and on this channel we talk about finance and investment. And one of the things that I try to share is, of course, how you can maximize the money that you've worked hard for. And that also includes what you've saved on the side. If you do have some money saved aside, which, it's one of the first things that you want to do as you're, starting to build your own financial wealth, you want to make sure that you have some money saved aside to cover certain things like emergencies, certain things that unforeseen events that may come up. And of course, maybe just for you to save towards a car, a house, and so on. Now, the benefit of you being able to have that savings on the side is it would help you to cover unexpected events. Okay. Now, the purpose of saving isn't necessarily just to secure the money, because as you save money on the side, you have to understand that there's some risk. Forget about the fact that, when you invest your money in stocks or bonds and houses and all that, your money could lose value because of just the market conditions. On the other hand, your savings money being saved also has some risk. And the risk of that is, a big one of it is inflation. The fact that the money that you're saving is losing value, and in this current environment is losing value significantly, is just because your purchasing power is being decreased every day. Now, as we know, inflation got as high as about 9.1%. It's gotten down to about 8.5%, and we're hoping that it's going to continue to go lower. But there's going to be some inflation in the market. The goal of the Fed is to keep inflation down to about 2% before they stop increasing rates. But that is not going to happen overnight. It's going to take some time. It could take at least, according to what the experts are saying, it's going to take at least a year or so, or even longer. And that could also cause a lot of disruptions in the market, all right, in terms of the financial market. So if you do have some money saved aside and you're not planning to use this money for emergency, of course, they always say that you should save at least 3 to a year, which is generally recommended, and I definitely recommend that as well. You want to have that saved aside to cover your emergencies, which will include your daily expenses or your monthly expenses, assuming that you've budgeted that, you have an idea of what you're spending every month. You want to have that amount saved aside for at least 3 to 1 year, okay, 3 months to a year worth of those expenses saved aside. Anything in excess of that should be considered something you can use towards extra investments, and in this case, like a CD. And that gets me to my point. CDs have always been a safe haven to put in your money because you earn higher interests over the course of the duration or up until maturity. And assuming you let that money stay till maturity, you're going to get your money back plus the interest. And you can always renew this as long as you want. But the benefit of CDs is that you have that money put in there and you're earning higher in return for it, instead of putting in a savings account or leaving a checking account, which, you're getting maybe 1% in this current market. So right now, there are two accounts that I'm going to recommend, and which are provided through Lending Club, and it's going to be online account, and the other one is Marcus by Goldman Sachs. And I'm going to be sharing that on my screen with you guys. The first one, let's look at the one by Lending Club. That is the best right now. And the reason is because it offers 3% APY, annual percentage yield, on a 12-month CD, which is amazing. Most of the banks currently are still offering maybe, about between 2% to 2.5% on a year plus, maybe 2-year CD, 3-year CD. And in fact, I saw one not too long ago that is offering up to 5 years, 60 months. And that's only when you can get up to 3% APY. But for this, through Lending Club, you can get up to 3% APY on a 12-month CD. That is amazing. Now, let's assume that you have, 30,000, 40,000 sitting on the side that you are not really planning to use. Now, this is, I know it's a lot of money, no doubt, But it can be as low as $2,500. That's the minimum to open an account with Learning Club, in this case, to have open the CD. $2,500. And if I do a quick calculation here, if you have your $2,500 to open that account for at 3% annually for 1 year, you're going to get about $75 interest on that. In my opinion, that is a lot higher than what you would get from the money sitting in a savings account. And trust me, it may seem like it's not a lot of money, but that adds up. Assuming you have, $5,000, that money is going to easily go up to, on the interest you'd make, about $150. And it goes on like that. It goes to 10,000, you get 300. And the goal here is to let that money just do the work for you. You don't need this money. You're not planning to use it for emergencies. You've just saved it aside, and it's just in excess of what you really need. And that's the point I'm trying to drive home here. The second company is provided by Goldman Sachs, all right? Goldman Sachs, which is Marcus by Goldman Sachs. Theirs is slightly different. They have different variations of their CDs. But if I go to their high yield CDs, on a 12 months, they offer about 2.7, which is not bad. But if you go to 2-year CD, they offer up to 3%. The benefit of Goldman Sachs over Learning Club is that you can open with as little as $500. So you don't necessarily have to have $2,500 to open an account compared to what Learning Club is offering. Again, $500 here, $1,000 there, it all works to make you some money. And again, this is money that it would have been sitting in a bank account being killed by inflation. And that is a point that you need to understand. Your money sitting in a savings account in excess of what you really need for your safety is being slaughtered away by inflation. We'll see what happens with inflation as time goes on. We don't really know exactly where the Feds are going. I mean, the next target rate increase is about 75 basis points, which we are not sure if that is going to happen or not. Some are saying it's going to be 50, some are saying 75, and it depends on what the reports that will be coming out this week in terms of consumer price index and the reports in terms of job and all those things that will be coming over the weeks. Those will really determine how the Feds will approach, increase in rates. But as we speak now, a word of caution. You don't want to lock in yourself to a 5-year CD at this point. And that is because interest rates are still going to go higher, which means the rate on your annual percentage yield on the CDs would also increase. So you don't want to keep your money tucked away in a CD for too long. A year is enough, in my opinion. Anything more than a year, you're probably going to be leaving some money on the table because CDs that would be offered in the next 6 months will probably come out with a higher APY. So it might be better to, if you have, let's say you have $5,000, you might do $2,500 for 1 year and for right now, and then wait for another 6 months to do another, $5,000, another $2,500, because your rate on that may be slightly higher. So that way you are open to capturing the rate as they increase. Rates are not going to go down. So the best you can have at this point is 3%, and anything in the near future would definitely be higher than this.